Chris Joye is an authoritative voice when it comes to the Australian investment markets, and he spoke to me about the geopolitics of the Middle East and how that's impacting his outlook for risk. We also spoke about whether or not the greenback remains a safe haven, what's in store for the Australian housing market, and why he thinks Australian interest rates are going to fall. Have a listen. Chris, without exception, it's always a pleasure to talk to you, but particularly on a morning where we've seen some pretty seismic events in the financial markets. The US president has tweeted that individuals residing in Tehran should evacuate. This has got some similarities to previous wars in the Middle East, but with someone who has thought very carefully about conflict and the impact of conflict on financial markets. What's your state of mind this morning?
Well, I think I mentioned in the chat before this podcast, and thank you for having me on the podcast. It's delightful here in the new studio. I was actually traveling from Zurich to Dubai, and I found myself woken up by a sudden jolt in the aeroplane. And I checked the in-flight map, and we were directly above Baghdad. And unbeknownst to me, at that particular point, the Israelis were in the midst of their first assault on Iran. I chatted my guys live from the plane, and I said, hey, what's going on? Because we had just hours prior taken profits on about 300 million of positions because we were worried about the risks of a conflict. And my guys sent me a headline, which was flares and missiles sighted above Iraq. I looked out the window. The plane was sort of veering in a different direction. On the maps, I could see that we were doglegging and zigzagging quite unusually. I didn't know at the time, but the Iraqi airspace was there and then being evacuated. I could see very fast-moving objects out of my window. Not sure if they were missiles or jets. But listen, at that juncture, I was happy we were clearing risk, and I was very, very exercised about just the low probability stuff. You know, does Russia get involved? Because they have a huge investment in Iran. Does China get involved? They have an even bigger investment, arguably. The Chinese buy, I think, more than 90% of all Iranian oil, about 2 million barrels a day. And, with Syria falling, China and Iran had lost a lot of their foundations of support in the region. Obviously Israel had dealt largely with Hezbollah, Hamas, and now was attacking Iran. So at that particular point, I was very, very worried about this sort of emerging. Some were talking about the possibility of full-blown major power conflict. What we've seen since is a remarkable set of successes from the Israelis. So they've got full aerial control. They've very severely impaired most of the ballistic missile capabilities. So they've taken out more than a third of all ballistic missile launches in Iran. The Iranians haven't been able to fly any aircraft at all. It looks like the Iranian leader Khamenei could be dealt a pretty mortal personal blow in the next few days. And as you've mentioned, the Americans look like they're about to jump in to the conflict. The Israelis need the MOD bunker busters that the B-2 stealth bombers have to penetrate the four-door hardened nuclear enrichment facility, which they've yet to attack. So they've basically destroyed Natanz, but they haven't attacked this very hardened facility that sits basically below mountains, and they need American support for that. And they have yet to take out Khamenei. So I think it's very interesting. Having been negative, I'm actually feeling much more constructive. So much so that last night we added back all the positions that we sold on Thursday night. So
in the space of about 4 days, you've had a bit of a shift in thinking?
Yeah, 100%. And markets have sort of correlated reasonably well. So risk rallied overnight, equities were higher, oil had been lower. And if Iran is subject to regime change, if Iran's nuclear weapons program is eviscerated, it's hugely positive for risk. Because it's been one of the most destabilizing agents in the world for a long time, and the biggest global sponsor of state terrorism through its proxies like the Houthis, Hezbollah and Hamas. The Israelis have also dealt pretty savage blows to the Houthis. They've taken out the Houthi leadership during this campaign. So I actually see it as potentially very risk positive. The thing I'm worried about is I don't know how they get involved, but can the Chinese try and elongate this once the Americans get engaged? We've thought for some time the Americans would get engaged. They moved 28 aerial refueling aircraft from the US to the region in the last 24 hours. So that seemed to precede, plans to unleash the 6 B-2 stealth bombers that they currently have based at Diego Garcia, which is 1/3 of their stealth bomber fleet, and the only aircraft that can carry these big bunker busters.
So what you've just described is a very fluid landscape, and the tail of this changes significantly if you have other vectors like the Chinese and the Russian enter the equation. So what are the calculations that you're making at the moment? You manage $15 billion worth of risk. You've got some skin in the game. What are the signs that you need to see before you feel a lot better about this?
We're monitoring this like real time. I've been getting a few hours a night sleep. I mean, I average normally about 4.5 to 5, but I haven't slept much for the last few sessions because we are sucking in real time intelligence all day, all night. So I have teams in London, Miami, Auckland, Sydney, and Melbourne, and we are very large traders of high-grade debt in those global markets. Most of our trading is in the US and Europe. We are the biggest trader in the world, actually, of now today Commonwealth government bonds here in Australia. But the calculus for us is really, one, are the Israelis going to embark on preemptive, unilateral kinetic action to basically hobble this weaponization program? That's very risk negative. So hence we took profits prior to that happening. But the stunning success that they've had is risk positive. And if the Americans can entrench that success, and the key is the campaign needs to move quickly. We need to see comprehensive, really accelerated results in terms of they need to remove the regime, they need to eviscerate the weapons programs, and they need to permanently disable all of the military capability that Iran possesses. So if all of that can be done in the next few days, and we're really talking about a few days, because I think they only have so much goodwill, particularly once the ballistic missiles dry up. We've seen a dramatic deceleration in the volume of ballistic missiles that have been sent from Iran to Israel. So if that progresses, that's super risk positive, and we've been adding risk, and that's my central case. The tails around that, do the Iranians do something crazy? Do they go chemical? Do they go biological? Do they send sort of a dirty bomb into Israel? I mean, that could open up a whole range of, really almost unimaginable consequences. And then back to our earlier point, does somehow China and Russia get involved in this? Because I don't think this is positive at all. I think it's really particularly negative for both, albeit that the flip side of that is it does give yet another precedent for China to have a crack at Taiwan because, obviously Russia invaded Ukraine because of territorial and security concerns. Israel's now, attacking Iran on broadly the same pretext, security concerns. China would have territorial and security concerns, and they look like they're rehearsing for a unification event. I think that would be super risk negative in the short term, but I don't see Trump really doing much about that. And whereas in the past, it could have triggered the ANZUS Treaty, we could have been on the precipice of World War III. I actually think China having a crack at Taiwan will be a little bit like China sort of absorbing Hong Kong. So I don't think it's necessarily as negative as it might have been.
So given everything that you've just described, that is a situation that would normally see quite a well-bid US dollar. Moving into safe havens. The Japanese yen's become a safe haven. The Swiss franc has also been favoured as well. But there's been a lot of discussion about whether or not the greenback still retains that gilt-edged safe haven status that it has for generations. Has your thinking shifted at all in that landscape?
Yeah, that's a super interesting question, and it's crazy complex. Basically the argument is that people are selling America and buying other currencies. I think the Fed's interestingly, you've got a situation where the Fed has behaved in a very, very political fashion for a central bank. They were cutting far too aggressively. We said they shouldn't have cut as much as they did last year prior to the election. Powell was definitely trying to help Biden and Harris out with whatever support he could supply. And then as soon as Trump won, they stopped cutting. I mean, they cut once more in December, but basically they said all the cuts are off and they haven't cut since. And actually the US inflation data has been very benign. GDP was negative in the first quarter. Inflation's been softer than expected more recently. Yes, we're going to get this tariff shock that will temporarily increase inflation, but the Fed previously in the first administration that Trump presided over looked through the tariff impacts on inflation because they argued, my words not theirs, but it would be like a pig through a python and temporary. And the Fed is sitting at a very restrictive interest rate setting. So they're sitting at 4.25 to 4.50%. They think the normal or neutral interest rate is about 3%. So given that growth is, for the time being, weak, if you believe what Trump is saying about government spending, he wants to reduce government spending by 15%, which would cut $1 trillion a year out of the US budget deficit, which would mean, say, $10 trillion of savings over 10 years, which would pay for all of his tax cuts. The totality of his tax cuts on our numbers will cost about $8.1 trillion. So that's key. And Doge, notwithstanding Musk's unfortunate departure from the administration, the Doge entity has already found $180 billion a year in savings. So that's 18% of that target, which is pretty good after, people have made fun of that. But I think that's actually extraordinary. Well, I think it's extraordinary to find $180 billion of cuts in only 6 or so months, 6 to 8 months. Will they continue though? Will they move from $180 billion of savings to $1 trillion? That's the open question. And I'm not nearly as confident.
Still got the midterms to contend with. There's a hard 26th deadline for that. That landscape changes.
100%. So personally, if I was Trump, I'd be driving super hard on the government spending cuts because that's the perfect storm. If you cut government spending, you have weak growth, you encourage the Fed to cut. Now, the problem is that Powell hates Trump, and Powell has been keen to kind of sheet home as much blame for all things related to the tariffs to Trump. And he's been trying to make life as difficult for Trump as possible. I mean, Trump hasn't made his life difficult. Trump has been out there saying, I want to sack Powell. When the equity market tanked 4% on that day, he backtracked at 1 million miles an hour. But the Fed should be cutting. The Fed, we're recording this, in mid-June. Yeah, and the Fed's about to meet. I think they'll be quite dovish, and I think expectations of cuts might increase. But the question is the dollar, and I think the dollar weakness is a little surprising because I think the Americans are about to show in Iran precisely why they are, regarded as the protector and lender of last resort, precisely why the greenback has been the reserve currency, and there's clearly a bit of a diversification play because global asset allocators have all been massively overweight the US. So I think at the margin, yes, there's some selling of US risk, which is putting downward pressure on the US dollar, but there's no doubt that the traditional correlations between interest rates in the US and the dollar in the US and the equities globally and the dollar have changed. This is what you're intimating to. Rather than the dollar rallying on equity sell-offs, the dollar has been depreciating. So I think that's interesting. I'm not sure it's a long-term impulse. I think it's more of a tactical short-term dynamic. I would not be selling America. I think Trump is going to invigorate the mother of all manufacturing miracles. I think his game plan is very clear. He wants to decouple from China, bring the manufacturing home. I think he's going to succeed. And if he does succeed, you're going to see huge demand for US assets, massive capital flows into the US. And then the final point is the Fed's unlikely to cut or has not cut as far as everybody else. We've seen the ECB cut very aggressively, the New Zealanders cut aggressively, the RBA is in the middle of what will be a fairly meaningful cutting program. So, if you look at where the Fed was at 5.5, they're at circa 4.5 right now. They have a long way to get to just normal and neutral, which is around 3. And inflation is coming down. Again, there'll be a temporary increase in inflation, but I would have thought the Fed needs to kind of move closer to neutral.
Well, that's important, that view that there will be an inflationary impulse at some stage. Do you have a handle on the timing of that? Because that's significant.
Well, the inflationary impulse should be here and now. It's coincides with the implementation of the tariffs, and the tariffs have been implemented. We're seeing the impact of the tariffs in the US budget data. They're generating massive revenue at the absolute maximum that we estimated, you're looking at up to 5.7 trillion in revenue over 10 years from the tariffs in US dollar terms. So that would pay for a big chunk of the 8.1 trillion in tax cuts, assuming no substitution effects.
It's got to get through Congress, though.
It's got to get through Congress. I think the US budget authorities estimate that the tariffs will generate something like 2 to 3 trillion more conservatively in revenues, and assuming substitution effects, probably 2 rather than 3. It's still a meaningful amount of money, and that'll push inflation up temporarily. But until we get the manufacturing investment, and a lot of people were skeptical on this manufacturing boom that I described. A lot of people think it will take years to come. But we saw Tesla stand up factories under tents in weeks. In New Zealand, when they had the tragic earthquake in Christchurch, they built a football stadium for 20,000 people in 90 days. And they'll be using the Coolabah Crusaders, if I can plug a team we sponsor. Many of you wouldn't know this, but are actually in the Super Rugby Grand Final this coming Saturday. I'm going across to New Zealand to watch the game. We started sponsoring the Crusaders last year. They basically had a terrible season, won very few games, but they're in the grand final on Saturday. But that stadium is the same stadium they built in 90 days after the Christchurch earthquake. So the important point is that when business is motivated, when business is incented, and Trump is giving everyone every incentive in the world to build stuff in America, they can move fast. So I think the investment will flow much more quickly than markets and experts think.
So back to the local landscape, though, that inflationary impulse, if it doesn't emerge in the next couple of quarters, there's still room for the RBA to at least be speaking more dovishly. They've had a big U-turn, you could say, in recent months. Do you expect rates to fall dramatically between now and the end of the year?
Yeah, so we argued last year, I said in our interviews last year that they wouldn't cut in 24 markets, and economists had thought they were going to cut. We had the view they'd cut this year. We said in December they'd cut in February, and then we argued they'd cut in May. They did both those things. So they've gone from 4.35% to 3.85%. The market is pricing in an RBA cash rate of only 3% by the end of this year. So that's 135 basis points of cuts. And we've already had 2. We'll get another one in July. That's all but 100% priced. And there are 3 total cuts priced for the RBA by the end of the year, another 85 basis points of cuts, so slightly more than 3. And that's really positive for Australia. Australia is, the Economist calls us the wonder down under. We're in this kind of really interesting situation.
You don't, though. You've been calling us something else.
I've been calling us, prospectively, we could emerge into something akin to Asia's Ibiza.
That's another conversation.
That's another conversation. But I think Australia's in this interesting position where in the short to medium term, you've got a lot of positives. You've got huge amounts of government spending at the federal and state level, massive budget deficits, initiatives like the NDIS, 60 billion a year, almost as big as Medicare. So that's very positive for growth. It may not be very positive long-term for encouraging the folks listening to this podcast to be entrepreneurs, innovators, etc. But for short-term growth, it's positive. Then you've got, stellar population growth, huge immigration, possibly related, or certainly would have lent some support to the Labor Party's success at the last election. And that's positive for growth in the short term as well. And then you've got the RBA cutting rates, and then Australia, providentially actually benefits from this trade war because, again, we get cheap goods that are dumped by the Chinese and their proxies, Vietnam et al. So BYD cars surging here. Their sales, multiples Tesla sales of EVs in Australia. So if they can't sell goods into the US, they're going to pivot into Australia. So that's actually going to push inflation down. That's disinflation. So I'm not worried at all about Australian inflation in the short term. I think over a 10, 20-year time frame, what we know in Australia is we have no productivity growth. We've got the worst productivity growth on a total multi-factor productivity growth basis since World War II. Our labour productivity growth is abysmal. And what is productivity? Because it sounds like a technical economist term, which it is, but it's just output per hour worked. It's basically what you're producing for how much effort you're investing into that process. And we are lagging everybody. We are miles behind the Europeans over the last couple of decades.
Which is saying something.
And miles behind, even further behind the Americans. And it's partly or mainly driven by the public sector. The public sector, government, is crowding out Aussie business. Government as a share of our economy is the largest it has been basically since the Second World War. 63% of all economic growth in Australia since 2019 has been public, not private growth, and 53% of all jobs created. So more than 1 in 2 jobs in Australia have gone to government sectors, not private sectors. So short term, that's all great, but in the long term, we become Asia's Ibiza, a beach resort for rich members of the Indo-Pacific glitterati.
So that's a generational thing that you're talking about in terms of what's down the road for the Australian economy. As far as the next 6 months are concerned, though, that decline in interest rates, is that going to be enough to kickstart activity? Because we've just been stumbling along at a flat line. We need lower rates based on your thesis. Is that going to be enough?
Yeah, I think it will. I think actually the portents are really promising. You know, construction and building have been in the doldrums. Business insolvencies have been at record highs. I think you're going to see all that data improve, and you'll see, most importantly, the best real-time transmission mechanism for monetary policy changes or interest rate changes is obviously housing. Australia has a very interest rate sensitive housing market, and we called this. We said late last year that if the RBA cuts in February, which was our expectation, house prices would start rising again, because house prices have been falling in Sydney and Melbourne since, in Melbourne's case, March 24, Sydney since September 24. And it is remarkable that when you look at the daily house price index data, which you can find online at CoreLogic's website, if you go to the back series tab, and you can look at movements day to day, literally the week the RBA cut rates, house prices stopped falling in February and they started rising again. So there's a huge U-turn in the market. Since February, Sydney and Melbourne house prices have been rising at a very modest but decent 5 to 6% annual clip. But since the May cut, Sydney prices have accelerated to start increasing at an 8 to 9% annual rate. So the housing market is the real-time leading indicator for how interest rate changes are percolating through the economy. And I think you will see an uptick in growth, building, construction, and then obviously as house prices rise, you get a bit of a positive sentiment and wealth effect. But is it a panacea? Are interest rate cuts going to help us in the long term? No. As you and I both know, you need the Harry Triguboffs, Kerry Packers, the Rupert Murdochs, the innovators, the entrepreneurs to create businesses, to drive growth. We need to compete on a globally relevant scale, and we're just not going to be able to do that because no one's making stuff in Australia anymore. There are very few innovators and entrepreneurs that are globally impactful, and with tax rates rising here, I think we'll lose some of the best businesses and brains overseas. And we're just not creating incentives to work very hard, which is coming out unfortunately, in that output per hour work data where we're lagging the Europeans and indeed much of the rest of the world. So it's pretty sad over a kind of very long-term timescale.
Well, Chris, we need your brain on shore, so hopefully that's not going anywhere. But it's always a pleasure to talk to you. I didn't think we'd be at risk of running up against time constraints today, but we have, because there's always so much to talk about. But thanks very much for your time.
Thank you. Appreciate it, Tom.